Good now.
That's okay. Thank you very much, Lou. Good evening, everybody. Can everyone hear me? All right. It's an honor to be here, really. I was so happy when I got the invite, and I'd like to congratulate everybody that works at Altfest. Our industry is super competitive. It's very volatile, and companies don't usually stick around for this long. So it really is a huge accomplishment to celebrate your 40th anniversary. Congratulations. Now, I'm here to talk about bonds, more specifically mortgage-backed securities. I'm going to try to keep it simple to make sure that I don't upset Lou. I'm going to explain what they are and why you should own them in your investment portfolio. In fact, as clients of Altfest, there's a chance that you already own it there. So hopefully this is at least kind of an informative thing for you. And I'm not holding my breath. It might even be, interesting to you, not just informative. All right. So my communications professor used to tell me, if you're going to talk about a dull topic, start with a flashy title. So here's my flashy title. Bonds are back. All right. So Lou kind of stole my thunder a little bit because he talked about how interest rates were so low for a very long period of time. When you're in that kind of an environment and rates are so low, as investors, it makes sense to hold stocks, equities, because low rates help growth, and that pushes stock markets higher. And so it was extremely rewarding to hold stocks for a very long time. Bonds, not so much, because rates were low, bonds were not yielding much. It didn't really add too much to a portfolio. And I always like to give myself an example. Like, I've been working for over 20 years in this country. I'm also an immigrant. I came from Turkey, also naturalized citizen, go USA. But for over 20 years, I've had a retirement account, right? I have 529s for my kids. All I ever owned in there were stocks. And I'm a bond portfolio manager. I didn't own any bonds for over 20 years because rates were so low, yields just didn't make sense. And that low rate environment helped stock returns. So that changed at the end of last year. Now I own mostly bonds in my portfolio. And what really happened was, in the aftermath of COVID, we started experiencing inflation for the first time at these levels in about 40 years. Like, we hadn't seen inflation this high. And our central bank, the Federal Reserve, when they realized that inflation wasn't going to go away on its own, they started embarking on rate hikes, increasing interest rates. And they did this in a very aggressive way. So this chart, if you can see the colors, the orange chart, well, these lines are all rate hike paths. They show paths of rate increases in these recent cycles where the Fed has increased rates. The cycle that we're in right now is the orange line. As you can see, it goes up really high and is very steep, which means they've raised the rates by the most in recent history, and they did that in the shortest period of time in recent history. Right? So this is why there were scrunchy faces when Lou was talking about bonds. This is why many high-quality bond funds were down 15% last year. Right? This is also why I have some of this gray hair. It was the worst bond market performance in at least 50 years. So what this kind of a crisis brings is, like, it brings opportunity, right? So we're here to talk about the positives and look forward. So as we stand here today, we have the opportunity to earn stock market-like returns by investing in high-quality bonds, not even high yields or high-risk bonds. In high-quality bonds, you can get the target returns that you would normally get from your stock portfolio today. The bond market is huge. There's lots of different kinds in it, and what a lot of people own and like right now is short-term treasuries. Right? Right now, the safest investment in fixed income, which is always short-term treasuries, they yield about 5%. And this is a historically very attractive return. For basically no risk, you can make 5%. Now, if you think about portfolio construction, usually from the risky part of your portfolio, you're trying to make 7, 8% in your stock market portfolio over a long term, right? Stocks go up and down a lot every year, but over the long term, you expect to make 7 or 8%. So to make 5% without any risk is huge. And that's why investors are like, I'm not going to take any risk. I'm going to wait in treasuries. That's what's going on right now. If not treasuries, they own money markets. Well, I'm here to argue that you should take some risk. You should look a little bit more into the long term. And the problem with short-term treasuries is if rates start coming down, and they're expected to start coming down later this year or early next year. Of course, we don't know for sure. But if that does happen, those treasury returns are going to be short-lived. Right? You're not going to end up making that 5% for a very long period of time. So let's look at other parts of the bond market. Let's take good quality risk, and let's earn these high yields over a longer period of time. And what we like at Angel Oak are mortgage-backed securities. So I'm going to tell you a little bit about what they are. Let's see if we can switch the slide here. Oop. There we go. Boxes and arrows. All right. So when you create a mortgage-backed security, you pool together a portfolio of mortgage loans. These mortgage loans are exactly what you think they are. It's what you get from a bank when you want to buy a house or an apartment, same exact mortgage. You put together thousands of them into this giant portfolio, and then the second step, you issue bonds that are backed by the principal and interest payments that are going to come from that portfolio of mortgages. So when the underlying mortgages pay their principal and interest, the bondholders or the mortgage-backed security holders get paid themselves. So those bondholders, the mortgage-backed security holders, now hold the risk of the underlying mortgages. Whoever made those mortgages in the first place, Bank XYZ, that was the original lender, sold those mortgages. It's out of that risk. That's why mortgage-backed securities exist in the first place, so that lenders can move the mortgages out and they can make more loans. Now, the risk sits with the mortgage-backed securities. Another hallmark of mortgage-backed security issuance is creating bonds with different risk and return profiles from the same pool of loans. So how do you do that? How can you create different types of risk from the same pool of loans? Well, you use what's called a priority of payments, also affectionately known as a waterfall. Now, it works just like a waterfall. I think it's easy to think of it that way. If you take all the money that comes, all the principal interest that comes from the underlying portfolio of mortgages, and you start paying the senior bonds first. So I just gave a simple example here. Senior bonds, mezzanine bonds, junior bonds, just three kinds. So the first one to get paid, the first one in line, are the senior bonds. Only after the senior bonds get paid all of the interest and principal that's due to them, do you move on to the next step. The waterfall keeps flowing, right? It fills up the first bucket, and then it starts flowing into the next one. Then the mezzanine bonds start getting paid. When they get paid fully, and there's still money left over, then the junior bonds get paid. So by creating this order of payments, you've created a senior, a mezzanine, and a junior investment, all backed by the same underlying portfolio. Now, if there's a shortfall in the portfolio, right, if somebody doesn't pay their mortgage, there's going to be less cash to start with, and that's going to create a shortfall in the junior bonds, right? So the junior bonds are the first in line to take a hit. That's the riskiest bond. The senior bonds, because they get paid first, obviously, it's the safest. So credit risk is higher at the bottom. Credit risk is safer at the top. And yields, they work the other way, right? You can basically say, okay, I'm going to pay the senior bonds. Well, let's say the mortgages themselves are yielding 8%. I'm going to say the senior bonds should make a lot less than that because they're so safe. It would take huge losses in this mortgage portfolio before those senior bonds can ever lose a dime. So the senior bond would be happy earning 6% instead of the 8% that the mortgage is paid. The mezzanine bonds, let's say they pay 8%, and the junior bonds, they pay 10%. So from the same underlying portfolio, I've created three different risk-reward mortgage-backed securities. All right, so there's also two broad kinds of mortgage-backs. You may have heard of agency mortgage-backed securities and non-agency mortgage-backs. Agency bonds are guaranteed by what is called government-sponsored enterprises. It's Fannie Mae and Freddie Mac. You may have heard of them. They guarantee these bonds. It's basically government-guaranteed risk, very close to it. So there isn't any credit risk there. We're going to be spending our time talking about non-agency RMBS, okay? So non-agency RMBS, you are actually taking the risk of the borrowers paying you back. These payments are not guaranteed by Fannie and Freddie. You need the underlying borrowers in those mortgages to keep paying their principal and interest so that the bondholders get paid. You're taking the credit risk of the borrower. Now, this risk is secured because every mortgage has a house, has a home underlying it, right? So you're secured, your credit risk is secured by the home. If these borrowers go delinquent, first the servicer will try to keep them current. They'll make modifications to the mortgages. If all else fails, they're going to foreclose on the home, sell the home, and try to pay the mortgage that way, right? So both the quality of the borrower is important and the value of the home is important. Home prices are an important metric for non-agency RMBS. Now, You may be asking, why are these loans not guaranteed? Why does Fannie and Freddie guarantee some loans and not other ones? Are these made to poor quality borrowers? Is that what I'm investing in? The answer is no. It's actually almost the opposite. There are a few reasons why the agencies don't guarantee non-agency loans, why loans become non-agency in the first place. The first one is size. This is very easy to explain in New York because the agencies will not guarantee a mortgage larger than $729,000. For some parts of the country, including New York City, that goes up to 1.1 million. A 1.1 million mortgage will buy you a $1.4 million home. That doesn't get you much in New York City, right? There are plenty of geographies or zip codes in the country where those sizes are just too small. People need bigger mortgages to buy homes in these expensive places. And so they go the route of non-agency RMBS. These kinds of non-agency loans are called prime jumbo. They're jumbo because of the size, it's big. They're prime because banks will only give prime jumbo loans to the very best quality borrowers. You have to be, if you know what FICO scores are, you need 800 FICO. You need lots of income. You need very little debt. You're the best borrower in America if you have a prime jumbo loan, right? So that's actually much better quality than a lot of the stuff that's guaranteed by the agencies. There's another reason, another important reason loans become non-agency, and this has to do with borrowers not being able to satisfy the extremely stringent documentation requirements for getting a mortgage. I don't know if anyone's gotten a mortgage in the last few years. It's very difficult. They ask for a ton of documents. And if you know, the first thing they ask for will be your tax forms. They look at your tax forms to verify your income. And if you don't have a lot of income in your tax form, it's going to be really difficult for you to get a mortgage. This applies for a huge portion of the population. There are self-employed borrowers. There are small business owners. There are wealthy retirees that don't make a ton of income, that don't show a ton of income in their tax forms. They have a hard time getting mortgages. They won't get an agency mortgage. They have to get a non-agency mortgage, even if they're an excellent quality borrower, right? I'm going to take a short detour here and talk about why it's so hard to get a mortgage, because this feeds into the quality of non-agency mortgage-backed securities. I'm going to take you back to the financial crisis, unfortunately. Leading up to 2008, lending standards were terrible. I mean, they were giving loans to people without jobs, without any income, because lenders didn't care about the quality of the loan. They would sell it to the bank. The bank didn't care about the quality of the loan because they would put it in a mortgage-backed security, which would be sold to an unsuspecting investor. Now, we all know what happened. Tons of defaults. Investors lost hundreds of billions. Many of the largest banks in the country got close to defaulting. Some of them actually did. Taxpayers had to bail out these institutions. Everybody was very upset. And so the regulator said, we're not going to let this happen again. We're going to change the rules around mortgage lending. And so they changed the rules. They made a bunch of changes. I'm going to talk about two important ones. First of all, they told lenders that lenders are now responsible for making sure the person they lend to can pay them back. Right? This actually kind of makes sense, right? If you're a lender, you're supposed to do that. But they didn't do that because they didn't care. Now, they made them legally liable. So this actually is a huge change, because now they're saying, well, the borrower can actually sue the lender for giving them a loan they can't afford. Which is crazy, right? The mortgage-backed security investor can sue the lender for making a poor quality loan. So lenders are super careful. That's why they have to verify your income. They have to document it. If regulators come and knocking and ask them, they have to show, yeah, look, I did the calculation. This guy can afford this loan. Huge change. The second change they did was they said, no more of this making loans and passing it off to the next guy. You got to have skin in the game, Mr. Lender, right? So they instituted risk retention rules. Lenders who securitize, who put their loans into mortgage-backed securities, have to keep a piece of that risk. Their own capital is at risk now. What better way to guarantee that these guys make good loans than saying, it's your money on the line, right? So between this ability to repay rule and risk retention rules, this has changed mortgage lending. It's made mortgage credit availability very tight, very difficult to get a mortgage. But on the flip side, only the best quality borrowers are getting mortgages today, which means non-agency RMBS is backed by very good quality borrowers, right? Okay. So, actually, we'll take back here. we're talking about credit risk, right? Even if these borrowers are excellent credit risk, you're still taking credit risk. You want to get paid appropriately for that. So come to the point. What do I get paid by investing in these mortgage-backed securities? Now, I talked to you about senior bonds kind of going down the stack. An easy way to think about that is to use credit ratings to think about the different kinds of risk. The senior-most bond gets a AAA rating. The one below that is a AA. The one below that is a single A. Triple B and above is broadly considered investment grade, right? These generally mean that there's a very low risk of principal loss. Right? So I've showed what the yields are in non-agency RMBS for AAA all the way down to single B ratings. As you can see here, AAA rated non-agency RMBS yields about 6%. Triple B rated non-agency RMBS yields about 8%, right? So lo and behold, equity market-like, stock market-like returns from investment grade quality bonds, 6 to 8%. If you go into the below investment grade parts, yields jump to 10 to 12%. And we're actually okay in many angel oak funds owning those kinds of risks as well. Because the borrower quality is so good, we don't mind taking these lower rated risks because under a lot of our scenarios, delinquencies are going to remain very low, and even those single B rated bonds are going to return the full expected principal to us, delivering these low double digit type returns. All right. So another reason why we like taking risk in the mortgage-backed securities is the strength of the housing market. So I'm going to spend just a couple of minutes talking about the housing market. As I mentioned, even if these borrowers go delinquent, if they default, if the housing market holds up, that means our risk is a lot less, right? Because those homes are going to be selling for higher prices. We're going to recover maybe all of the money we put in the first place and not lose anything. So the way I would describe the housing market today is a supply-demand imbalance, right? So let's break that down. Let's look at the supply side first. There's a chronic shortage of homes in America. This started in the aftermath of the financial crisis. Again, I'm taking you to the same place. So the orange line at the bottom shows you new home inventory. At every year, how many homes were built to be sold. This goes back to 1982. There's a little hill in the middle. That's 2007. They were building a lot of homes because the market was booming. Everybody was taking mortgages. It was easy. Well, after the financial crisis, you see a big trough. For many years, home builders stopped building homes. And that's really what contributed to this shortage of homes. And even now at 2023, we've barely made it back to the pace of producing these homes on any given year. Now, these are every year. So every year you're low, you're creating a shortage of supply. The blue line is existing homes. That's everything. It's not just new homes. Everything that's out there. As you can see, that's even worse. In 2007, it peaked around 3.5 million homes available at any point for sale. Now we're at about 1 million homes of inventory. Over the past 40 years, it's the lowest supply we've ever had, the lowest inventory we've ever had for homes. That's the supply side of the equation. Just a long-term structural shortage of homes. The demand side of homes, it ties to demographics, right? We have close to 19 million millennials in America. It's the largest generation to ever come. And millennials are at prime household formation age. They're all getting married, they're having babies, they want to move to homes. That's creating a surge in demand for homes. This is even before COVID and people wanted to move into other parts of the country where they could work from anywhere. Like this predates back. So massive demand coming in the face of ultra short supply. This means home prices are going to hold up very well. Even when this recession, if and when this recession comes, it's 50-50. Even if it comes and it's very nasty, home prices are going to outperform. They're going to be the best asset you hold. That's our view. And as a result, we think non-agency RMBS is going to be among the best performers in the world of credit. And we'll kind of look at the reasons for that, just summarizing what we've been through. One, attractive yields, 6 to 8% for investment grade quality bonds, low double digits for below investment grade quality bonds. Very strong borrowers. Only best quality borrowers are getting mortgages. So we have very strong borrowers in non-agency RMBS. Strong housing market, supply-demand imbalance, right? Structural protection, this goes back to the waterfall. You can invest in the part of the waterfall where you're protected against defaults. Defaults in the portfolio aren't going to hurt you until they really build up. So the structure protects you in the first place. And finally, diversification. There's thousands of loans in there. Even if there's a mishap and someone did poor underwriting on one loan, it's not going to affect you because it's a very, very small part of the underlying pool. So no discussion of investments is complete without risks. So what's the catch, right? Well, the real risk, the only real risk in investing in non-agency RMBS today, in my opinion, is the risk of rates continuing to go up. If inflation is not under control, if rates are going to continue to go up, this is not a good time to buy these bonds. We think that's not the case. We think things are turning. We're still in the cycle, but we think we're about to come out of it. That's why it's tough to time markets at their bottoms. I think this is the time to start looking at these investments and locking in these excellent returns. Bonds are, non-agency RMBS is also a complicated asset class. It's tough to analyze these loan pools. It's tough to analyze these bond structures. So what I'm trying to say is I'm a professional. Don't try this at home. If you are intrigued about this, please talk to your representatives at Altfest. This concludes my presentation. I hope you enjoyed it. Thank you very much.